This is a dollar franc opportunity from last week. I knew it was solid market selection because the price had pushed up into a strong weekly reversal zone for the first time in a while. The price went on to fail at this 4-hour extension level, and then I was hit with this entry opportunity. A type 2 close at a swing high and B point of a confirmed range multiple times. Now, I debated this one for a while. I knew there was a stronger path of resistance just above the price. Not only could the price be attracted up there, but if it did and then failed, it would be an even better setup. So I didn't take the trade. And that was the wrong thing to do. Not just because at the time of filming this, the price has now dropped nearly 400 pips. It's bad form to judge your decisions based on what happens next. Instead, my problem was that I made a common mistake that affects most traders. Now, that dollar franc opportunity isn't important for now, but if you do want the full details of it, I sent a full breakdown to our mailing list last Wednesday, and if you didn't receive that video, it must mean you're not part of the list. But don't worry, I send new trade breakdowns every week along with other great emails, so if you want to catch them, the link is in the description box and it's free to join. So, what I was faced with was a decision. And whether we realize it or not, when we make decisions, we're actually attempting to forecast the future. For example, if I'm going to a meeting and I'm deciding how to get there, whether I'm going to get the tube, an Uber, or just walk, I'm calculating the probability of each of those getting me there on time and assessing that against other possible benefits and downsides. For example, I might think there's a big possibility of traffic, so that rules out the Uber. There's a chance of rain, so I might not walk because I don't want to turn up like a drowned rat. And although I hate getting the tube, the likelihood of a delay is quite low, and so I might take that option. The problem is, as Lyle Ungar says, most people are sloppy when they think about the future. They say things like, it's likely we'll go to Hawaii for vacation this year. Well, does that mean that it's 51% certain or 90%? Because there's a big difference if you're buying non-refundable tickets. To put this in perspective, look at the results of this study on intelligence analysts at the CIA and the use of words of estimated probability. There's a huge range of different answers about the probability that's implied by each of those phrases, and these guys are meant to be some of the best in the world at this. Now, as traders, non-refundable tickets to Hawaii are the least of our problems. A big difference in probability can be the difference between positive or negative expectancy. In other words, whether we should take the trade or not. So how do we improve our abilities in this department so we can make better decisions? Well, the Good Judgment Project, co-founded by Philip Tetlock, the expert on super forecasters, encourages people to focus on probabilistic thinking. A simple version of this is where you assess all the information and generate a range of potential conflicting outcomes from the situation and then assign a relative probability to each one. They found that just going through simple probabilistic training of this sort led to people seeing a 50% increase in the accuracy of their predictions. In an earlier video, I explained my approach to trading, a style that I call a context-based approach, using the Duomo method. And this type of probabilistic thinking that I just explained is a critical part of that. Most traders just try to figure out what they think the price will do next, and then they trade that single outcome. Well, to be honest, most traders don't trade what they think will happen, they trade what they hope will happen, and that's a whole nother thing, something we could discuss another time. But this is how we're accustomed to think. Since we live in one reality, we don't tend to think about multiple possible outcomes, we think about one. But what I do, and what I encourage you to do as well, is to think about all the potential outcomes and then using the information you have, assign a relative probability as a percentage to each of those outcomes, as well as considering the risk that's required and the potential reward for each one. You can start off with the first order outcomes, and as you get better at it or when necessary, you can also look at the second or third order outcomes as well. Then you don't just trade the one that's most likely to happen or has the highest potential profit, you trade the one, or ones plural, that have a positive expectancy high enough above a wide margin of error. And this is a much more effective way to trade than just trying to predict which single outcome will occur. But it's at this point that I made my big mistake with that dollar franc opportunity. You see, I did assess all the potential outcomes, as I always do, but I broke an important principle of analysing this sort of information. In fact, Richard Hewer, who spent 45 years in the CIA and is famous for developing methods for analysing competing hypotheses, has called this the most important principle. It's known as deferred judgment. As Hewer says, the principle of deferred judgment is undoubtedly the most important. The idea generation phase of analysis should be separated from the idea evaluation phase, with evaluation deferred until all possible ideas have been brought out. This approach runs contrary to the normal procedure of thinking of ideas and evaluating them concurrently. In other words, don't make any decisions or judgments until the analysis is finished. As traders, we're constantly battling against our cognitive biases, and we have plenty of them. And I often see traders breaking this rule of deferred judgment. They'll be doing their analysis and making judgments about where the opportunities are before the analysis is complete. Or even worse, they'll find what they think is an opportunity and then do the analysis just to confirm that it is an opportunity. But this causes you to miss important information and make badly informed decisions. I knew that there was a stronger path of resistance a bit further above the price, and it was a better opportunity that I wanted to take. So this affected the way that I judged the current situation, and I missed that it actually had a very strong positive expectancy. If I had broken down the potential outcomes first, without having that bias, I could have looked at the overall situation much more objectively. That would have given me the chance to figure out a strategy for the overall situation rather than being pigeonholed with one specific thing that hadn't even occurred yet. And in the end, without realizing, I put the decision ahead of the full analysis and cost myself a trade that at the time of filming this video had the potential to be a 40-1. Now, fortunately, these errors don't happen that often anymore for me, but as traders, we are always a work in progress, and it's really good to always be self-reflective and self-critical so we can keep improving and find those areas where we maybe need to keep ourselves in check. So if you want to know more about my context-based approach to trading, check out this video that's on screen, or as I said earlier, sign up for our mailing list to get my trade breakdowns and other goodies every week. The link's in the description box below and it is free to join. Hit the like button if you found this one helpful. Thank you for watching, and I'll see you next time. Take care.